Good afternoon. George Cavaligos for HFT Bonds. It's Sunday afternoon. In about, I don't know, 20 minutes, the market's going to reopen. And I've just sent out an email because I wanted to highlight something that I think is pretty important for the upcoming trade here. There's two big events, really, that I wanted to highlight. And the first one, if you click on the link in the email, is the Commitment of Traders data that was published Friday afternoon on the 10-year note. We have some big moves there. All the dealer shorts have been covered. They're a little bit long. Remember, this data is from last Tuesday, the 8th of January, so it's a bit dated. But it's something that I think is still going on, and it's something that we have to pay attention to. I think it explains some of the rally that we saw on Friday, too, but let me go a little bit through it here. When you open the email, take a look at it for the subs that are getting the email. Take a look at the charts. You can see the bar that denotes the small speculators, the yellow bar, going down quite a bit. It's actually the biggest net short position for small spec accounts in the last year and a half, by far. And that, I think, is providing this underlying bid in the market at this point. At least it's one of the things. The other thing is we have been noting, the recent decline in the dealer short positions as another driving force for some of this bounce that we've seen off the lows in the last week. It's been tough. I'll tell you, it's choppy, it's crazy, but I think it's going to clarify itself here this week. The dealers are now net long. Not huge, but they're net long 10-year futures on top of what we think is still a fairly substantial long cash treasury position. The hedge funds have cut their longs by quite a bit. So I think we have a little toxic brew here of too many small spec shorts, dealers that are getting long, and those are the smart money guys. Those are the guys we want to follow. And the hedge funds who've been pretty poor, cutting their long positions to the smallest, I think, in probably 4 or 5 months, just looking at the chart roughly here. Okay, that explains, I think, some of the big rally on Friday. I think small specs tend to not take positions home over the weekend. I think a lot of those small spec accounts covered over the weekend, but it's not really showing up in the open interest data either. I think there's still some shorts out there. I think the early part of this week, barring any major surprises, the treasuries are going to have a tendency to trade higher again. There's no treasury auctions until the last week of January, really, of coupons. They're auctioning bills like crazy every week, but there's demand for the bills. Just for collateral purposes, I think there's plenty of demand for the T-bill auctions. So that is not a worry for us. The next coupon auction, I want to say there's a TIPS auction next week, and then the week after that we come with 2s, 5s, and 7s. It's a long stretch of no coupon auctions. Now we just got done with, a big sequence of auctions, and the market rallied right through it. We saw some selling afterwards, and now the market's recovered on Friday quite substantially off of a off of a double bottom chart on the bonds. That 144.11 618 fib retracement held like a champ. We double bottomed off of that. And I wasn't quick enough to catch this, but notice the divergence there on Friday. The 10-year made a lower low, the bonds did not. Screaming buy, and I don't know why I didn't catch it until much later, unfortunately, but it's there. The targets for the, double bottom are way up there. I want to say low 146 handle, high 145 handle, which we're already trading right around 145, 10, 11 in the pre-opening here. So I think we're going to see some higher prices. The old highs up here on the 10-year at 04 are going to be a stumbling block. The old highs on the bonds are, what was the high last week? It was 145.05, no, 145.20. And we're almost there. We got to 145.19 Friday afternoon. Did come off from there as the market got a little bit overbought. I'm thinking it's still going to come off a little bit tonight. The dollar is again very weak. I think we could see some selling from our friends in Asia again. I don't think we'll see as much selling from the hedge fund guys. I think they might be done selling. So if you're not up very early in the Asian hours, you might have to buy a little bit of a bounce off the lows tomorrow morning as we wake up, or try to wake up early and try to grab this thing a little bit. Or stay up very late tonight and try to catch that midnight to 2 a.m. Asian weakness. Hopefully it's going to be there with this move in the dollar. And we might get some London hedge fund selling. They're still long. The dollar trade is hurting our European and Asian bondholders more than it hurts anybody here in the States, obviously, because we transact in dollars. We don't have to shift our funds from euros to dollars and dollars back to euros, or Japanese yen back and forth from dollars. So there'll be some buyers here in the States that we might not see in Europe and Asia. And that's the other problem that I want to highlight here. The last 2 days we have seen the biggest down move in the US dollar index that I think we've seen in quite a long time. We have to watch that. I know we're domestic users of the bonds and notes. There's quite a bit of that going on. Pension funds, insurance companies. There is huge real money buyers for this stuff. But the biggest holders of our debt are still overseas. And we have to watch what they're doing. We have to be cognizant of what the dollar is doing. It is approaching some fairly significant levels on the downside. And it's approaching them quickly and without a lot of hubbub. I don't hear a lot of people going, oh my God, look at the dollar. Really don't hear a lot of that. And that worries me, because that could be a problem. If our dollar goes down, if our friends in China that own our bonds get nervous about that and start to sell more bonds than we're capable of buying, we could turn around here and go south. I don't think it's going to happen right away. I see that small spec short position. I'm sure those guys are like a lot of us. The bond bubble's over. I want to jump on the short side. Well, we did a 5-wave move down off of 152, 153 area. We got down to 143 and a half, 144. We're at the bottom of the range. I don't think you want to be short down here at the bottom of the range. I think if somebody puts a gun to my head, I'm going to be long down here at the bottom of the range with stops below the old lows or something like that. Okay, I'm sorry I didn't get this video out sooner. I was having some kind of weird email issues again, and the links that I have for this YouTube production facility are all in my email account. I need to separate them out somehow. That's my project for tomorrow. Market's opening up, let's see, 10 years are trading unchanged, 131.29. The bonds are trading 145.09. I was hoping if the bonds get down towards the old highs at 145.07 to maybe try a small long down there. I think you might want to let it go a little bit further. The yen just gapped down again and made new lows. Let's take a look at that 144.31 level as a place to maybe buy on the bond side. And on the 10-year note, the big volume levels from Friday around that 131.23, 131.24 level before we try to buy them, and hopefully we'll see those levels overnight. Okay, be careful. Keep a close eye on the dollar index. I think that's going to be a key driver for us. And like I said in the email, the way I want to play this is I want to buy dips in the treasuries with a wary eye on the dollar index and another eye on the exit button at all times here. Make sure you have good sell stops based on your risk parameters too, okay guys? Have a great night, and I'll see you tomorrow morning.